This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers lending to banks, selecting a bond that is a good fit for you, bond mutual funds, guaranteed investment contracts, and private mortgages. Many people choose to save and invest their money in banks. Banks make money by taking deposits, paying a low rate of interest on those deposits, and then lending the deposited money out at a higher rate of interest. In other words, banks take your deposited money, offer you a safe, secure, low to no risk investment, and an ultra low return. They then use your deposited money to make higher risk, higher return investments. Banks keep the difference between the high return and low return, sometimes called the spread, as their profit. For most people, banks are a good place to keep savings, but not a good place to invest, as the returns are too low and often do not even keep up with inflation. For people who are extremely risk averse, banks are a decent choice for investments, as they offer many secure investment options. This FDIC insurance makes saving and investing in a bank safe and secure. If the bank where you keep your money fails, the FDIC insurance will make you whole on your savings and investments up to the insurance limit of $250,000 per account. It's important to note, though, that some products offered by banks are not FDIC insured. Many banks offer annuities, bonds, stock, and other investments that are not FDIC insured, so it pays to do your homework when considering such an investment. If you are ever in doubt as to whether your savings or investments at a bank are FDIC insured, call 1-877-ASK-FDIC to speak to an FDIC representative who can answer that question for you. CDs are essentially no-risk, ultra-low return investments. If you're willing to tie your money up for a set period of time, a bank will offer you a guaranteed return. That return has to be low because the bank will then take your money and use it for higher risk, higher return investments to make a profit. Our author calls CDs overused, and I have to agree. CDs should be used only by those who are extremely risk averse and who need completely safe, secure investments to sleep at night. Money market funds are a type of mutual fund that invest in short-term debt securities. They typically provide a higher rate of return than a savings account, and they allow quick and easy access to your money, so they are liquid. The additional return is good, but you must keep in mind that money market funds are not FDIC insured, so there is some risk involved. Most money market funds won't break the buck, meaning that they won't have a net asset value that falls below $1, but it is remotely possible that one could. So it pays to do a little homework and understand the small risk involved in keeping your money in a money market fund. Aggressive investors who primarily invest in stocks may buy some bonds for diversification purposes. A bond is essentially a loan. You loan your money to a company or government entity for a certain period of time for a certain return. For example, you might buy a $1,000 bond that matures in 10 years and pays 5% interest each year. If you hold the bond for the entire time, you will receive 5% interest, so $50, each year. Then, when the bond matures in the 10th year, you will receive your $1,000 principal back as well. However, you do not need to hold the bond until maturity. Instead, you can sell it in the bond market. Let's say that in year 5 of this 10-year bond, you decide that you need your money. You can sell the bond and it will be worth more or less than the $1,000 you paid, depending upon what the market interest rate for similar investments is. For example, let's say that your bond pays 5% interest, but now in year 5 interest rates have fallen and a similar investment pays only 2% interest. Well, in this case, someone will pay a premium to buy your bond because they will earn a higher rate of interest than on similar investments available now. Or, if similar investments are paying 10% and your bond is only paying 5%, when you try to sell it in year 5, it will sell at a discount, so for less than $1,000, because investors would prefer to buy bonds that pay 10% to bonds that pay 5%. In any case, bonds are riskier than CDs, so they should offer better returns to compensate for that risk. If an investor invests all of his or her money into the bonds of a single company, they are not diversified. If that company fails and declares bankruptcy, the bondholders will likely get only a percentage of the money they invested back, and may even end up with nothing. We know it's not wise to put all of your eggs in one basket. Instead, smart investors seek diversification. They buy many different bonds. Analyzing bond terms and risk can be complicated and time-consuming. Instead of doing all of this work on your own, you may prefer to invest in a bond mutual fund or bond exchange-traded fund. That is a fund that pools investors' money together to buy a diversified portfolio of many different bonds. There are many excellent bond companies out there. PIMCO is a leader in the bond mutual fund and exchange-traded fund market and has a good website for learning more about these types of investments. Guaranteed investment contracts are typically offered by life insurance companies and operate pretty similarly to CDs. The investor invests money and is paid a low interest rate. The insurance company then invests the money in slightly higher risk investments and keeps the spread as profit. The investor is paid a higher rate of interest than a CD because the investment is not FDIC insured, so there is increased risk. Insurance companies sometimes fail, and when they do, investors in guaranteed investment contracts do not get all of their money back. Private mortgages occur when an investor lends money directly to someone for a mortgage or second mortgage on a home. Most borrowers of private mortgages are not great credit risks, so they must pay a higher rate of interest in the private mortgage market. While returns on private mortgages can seem good, investors would be wise to think carefully about getting involved with this type of investment. There can be a fairly high risk of default, and even though the mortgage is secured through the use of the home as collateral, investors can lose quite a bit of money going through a foreclosure process and sale. That is the end of this presentation. I hope you enjoy reading the chapter.